Welcome back to our channel, Novel Nuggets. Today, we're summarizing one of the most transformative books on personal finance, The Psychology of Money by Morgan Housel. But here's the thing, this isn't your typical money management book. What if I told you that your IQ has almost nothing to do with whether you become financially successful? Sounds controversial, right? Well, Morgan Housel proves it through fascinating stories of millionaires and billionaires who lost everything and ordinary people who built incredible wealth. The core premise is this: doing well with money isn't about intelligence or mathematical prowess, it's about behavior. A genius without emotional control becomes a financial disaster. Meanwhile, ordinary people with basic financial habits become millionaires. Why? Because they understand the psychology of money. Throughout this book, Housel uses real-life examples to show how our emotions, experiences, and psychological biases shape every financial decision we make. Whether it's greed, fear, or simple human nature, these forces drive financial outcomes far more than any spreadsheet ever could. So let's explore all 20 chapters and unlock the behavioral secrets to financial success. Ready? Let's go. Chapter 1 is titled No One's Crazy, and it's the foundation for understanding why people make the financial decisions they do. Here's the mind-bending statistic. Your personal experiences with money make up maybe 0.0000000000001% of what's happened in the world. Yet, those experiences probably represent 80% of how you think the world works. Think about this. If you were born in 1950, the stock market was essentially flat during your teenage years and 20s. You watched your parents struggle through the 1970s stagflation. Naturally, you'd be skeptical about investing in stocks. Now, if you were born in 1970, the S&P 500 increased over 1,000% during your teenage years and 20s. You watched an unprecedented bull market. You'd naturally be bullish about stocks. Same market, same data, completely different conclusions. Neither person is crazy. They're both responding rationally to their own experiences. This explains so much about financial behavior we find inexplicable. Why does someone spend $400 a year on lottery tickets? From their perspective, they're not being irrational. They're paying for hope and possibility. You can't understand the decision without understanding their background. Chapter 2. Luck and Risk. This is one of the most important but uncomfortable truths in finance. Here's what we don't want to admit. Not all success is due to hard work, and not all poverty is due to laziness. Luck and risk play enormous roles. Consider Bill Gates. Everyone celebrates his genius as an entrepreneur. But here's what's less discussed. Bill Gates attended one of the only high schools in the world with a computer in 1968. One teacher had the vision to get a $3,000 computer for the school. Without that luck, without access, most people never had. Would there be a Microsoft? Gates himself admits, if there had been no Lakeside High School, there would have been no Microsoft. At that same school were three brilliant students: Gates, Paul Allen, and Kent Evans. Kent was just as talented, but Kent died in a mountaineering accident before graduation. Bad luck, and the world never knew his name. This isn't about dismissing hard work, it's about recognizing that outcomes are determined by a combination of effort, luck, and risk. When you judge people's financial success, you're only seeing the effort part. The luck, that's invisible. Chapter 3. Never Enough. This chapter is about one of the most destructive human behaviors, the inability to know when to stop. Two famous writers, Kurt Vonnegut and Joseph Heller, attended a party hosted by a billionaire. Vonnegut makes an observation to Heller. Look at our host. He makes more money in a single day than you made from Catch-22. Heller responds simply, yes, but I have something he will never have. Enough. That answer contains profound wisdom. The book discusses two cases: Rajat Gupta and Bernie Madoff. Both were extraordinarily wealthy. Both risked everything for more. Both ended up in prison, having destroyed their reputations and families. Why would someone with $100 million risk it all for $200 million? Because they define themselves through the pursuit, not through achievement. Here's the problem. Social comparison is a game you cannot win. There will always be someone richer than you. Always. Unless you're the richest person on earth, which you're probably not. You will lose at this game every single time. The hardest financial skill isn't picking stocks or optimizing your portfolio. It's defining what enough means to you. And then, this is critical, actually stopping when you reach it. Because here's the truth. Life isn't any fun without a sense of enough. You can never enjoy what you have if you're constantly reaching for more. Chapter 4. Confounding, Compounding. This chapter is about time and why it matters far more than you think. Here's a fact that should change how you think about wealth. $81.5 billion of Warren Buffett's $84.5 billion net worth came after his 65th birthday. Let that sink in. He was already a billionaire, but compounding works so powerfully that the vast majority of his wealth arrived in his later years. Here's where people get it wrong. Buffett isn't a genius at picking stocks. His returns? About 22% annually. Good, but not unheard of. Other investors have matched or exceeded that. Jim Simons, the mathematician's mathematician, achieved higher annual returns than Buffett. But you know how much wealth Jim Simons has compared to Buffett? Significantly less. Why? Time. Buffett has been investing for 75 plus years. Simons, much shorter timeline. You don't need tremendous force to create tremendous results. You need tiny, consistent forces over decades. That's compounding. Buffett's strategy is almost comically simple. Earn reasonable returns consistently for as long as possible. Do that, and the math of compounding does the heavy lifting. Chapter 5. Getting wealthy versus staying wealthy. This chapter reveals a truth that can change your financial destiny. Here's the statement that cuts through everything. There are a million ways to get wealthy. There is exactly one way to stay wealthy. A combination of frugality and paranoia. Getting money? That requires taking risks, being optimistic, putting yourself out there. You need boldness. Boldness gets you to the table. But staying wealthy? It requires the complete opposite. Humility, fear, conservatism about what you've already earned. A venture capitalist once said, "We assume tomorrow won't be like yesterday. We can't rest on our laurels. We can't assume yesterday's success translates to tomorrow's fortune." And Nassim Taleb, who studies risk, said something profound. Having an edge and surviving are two different things. The first requires the second. You need to avoid ruin at all costs. The survival mindset has three parts. First, be financially unbreakable. Don't go for the biggest returns. Go for the strategy that lets you stick around long enough for compounding to work. One panic sell can destroy decades of gains. Second, plan for failure. The most important part of any plan is planning for it not to go according to plan. Third, maintain a barbell mentality. Be optimistic about the future, but paranoid about threats to getting there. Take calculated risks with one portion of your money. Be terrified about protecting the other portion. Chapter 6. Tails, you win. This is the chapter that reframes what failure actually means. Here's something that seems impossible. An investor can be wrong half the time and still make a fortune. How? Through tail events. Events at the tail end of a distribution curve. The far outliers that have disproportionate impact. There was an art collector named Heinz Berggruen who became legendary for his investing acumen. People marveled at his ability to identify valuable art. The reality? He bought massive quantities of art. Most of it became worthless or moderately valuable. But a small number of pieces, his tail, became extraordinarily valuable and made him incredibly wealthy. Berggren could be wrong most of the time and still end up stupendously right. In venture capital, they're honest about this. If a fund makes 100 investments, expect 80 to fail completely, a handful to do reasonably well, and 1 to 2 to drive the fund's entire returns. They structure everything around the expectation that most things fail, because tails drive everything. Warren Buffett has invested in 400 to 500 different companies over his lifetime. Know how many drove his significant gains? About 10. It's normal for most things to go wrong, break, fail, and fall. The winners are simply the people who do enough things that the rare successes far outweigh the failures. Expect to be wrong frequently. It's part of the process. Chapter 7. Freedom. This chapter cuts through all the materialism and gets to what money is actually for. The ability to do what you want, when you want, with who you want, for as long as you want. This is the highest dividend money pays. It's priceless, and it's not about buying things, it's about buying time. Think about how this compounds. A small amount of wealth means taking a few days off when you're sick without breaking the bank. That's freedom. More means waiting for the right job instead of taking the first one after getting laid off. That's freedom. Even more means having 6 months of expenses saved, so you're not terrified of your boss. That's freedom. Still more means taking a job with lower pay but flexible hours or shorter commute. That's freedom. Here's the paradox. We've gotten wealthier, but many of us have lost control of our time. We've traded higher salaries for bigger houses, nicer cars, and more possessions. We bought the trappings of wealth, but gave up the one thing wealth is supposed to provide: time freedom. A person with a modest house, no mortgage, and flexible work has more real wealth than someone making twice as much but working 70 hours a week and stressed about their mortgage. Money's greatest value isn't in what you buy, it's in the freedom to not do things you don't want to do. Every dollar you earn is only valuable if it can eventually give you options over how you spend your days. Chapter 8. The Man in the Car Paradox. This is about one of the biggest psychological traps with money. When you see someone driving an expensive car, what do you think? Most people think, wow, if I had that car, people would think I'm cool. Not, wow, that person driving that car must be cool. That's the paradox. You're admiring the object, not the person. Morgan Housel wrote this letter to his son when he was born. You might think you want an expensive car, a fancy watch, and a huge house. But I'm telling you, you don't. What you want is respect and admiration from other people. You think having expensive stuff will bring it, but it almost never does. Especially from the people you want to respect and admire you. This is the uncomfortable truth. Humility, kindness, and empathy will bring you more respect than horsepower ever will. The people worth respecting don't respect you for your possessions. They respect you for your character. Your possessions can't buy respect. They can only buy envy. And those are not the same thing. Chapter 9. Wealth is what you don't see. This chapter reveals the irony at the heart of financial life. Here's the irony. Wealth is what you don't see. The expensive car you see. That's not wealth. That's a reduction of wealth. That person now has $100,000 less than they did before. Most people use these words interchangeably. They shouldn't. Rich is a current income. If you're driving a $100,000 car, you probably have a certain level of income to sustain those payments. Rich is visible. Rich goes out of its way to be known. Wealth is hidden. Wealth is income not spent. It's the car you didn't buy, the house you didn't upgrade to. It's optionality, the ability to buy something later if you want to. When people say, I want to be a millionaire, what they really mean is, I want to spend $1 million. But that's literally the opposite of being a millionaire. A true millionaire is someone who has accumulated $1 million in assets and hasn't spent it. The spending would immediately disqualify them from being a millionaire. The world is filled with people who look modest but are actually wealthy because they don't spend their money, and people who look rich, living in mansions, driving fancy cars, but live on the razor's edge of insolvency. You can't tell who's wealthy by looking at them. That's the whole point. Stop judging wealth by what you see. The visible is the opposite of wealth. Wealth is the invisible, what you earned and didn't spend. Chapter 10, Save Money. This chapter proves that how much you save matters more than how much you earn. Here's the statement that changes everything. You can build wealth without a high income. You absolutely cannot build wealth without a high savings rate. Which factor matters more is obvious. Past a certain income level, people fall into three groups. Those who save, those who don't think they can save, those who don't think they need to save. The difference? Mindset, not circumstances. Most people think, I need to earn more money to build wealth. But here's the reality. If you reduce lifestyle bloat, you get the same gap as earning more money, but you have complete control over it. You can't control whether your boss gives you a raise. You can absolutely control whether you spend less. In the 1970s, there was an oil shortage. Oil supply increased 65%, but fuel efficiency and conservation doubled what could be done with that energy. Supply side, out of people's control. Demand side, completely within individual control. The demand side, won. Here's the psychological truth. Savings are the gap between your ego and your income. More humility raises your savings rate faster than any raise ever will. The unseen return on savings, flexibility, control over your time, the ability to wait for the right opportunity instead of taking the first one. That flexibility and control have an infinite ROI. Chapter 11, Reasonable Greater than Rational. This chapter is about your psychology, not mathematics. Here's the paradox. Being coldly rational about investments often leads to worse outcomes than being reasonably imperfect. Why? Because reason allows you to sleep at night. Rationality doesn't. Consider this. Almost nothing is more correlated to investment success than commitment to a strategy during its lean years. You can have the perfectly rational strategy, but if you abandon it when it hurts, it fails. You can have an imperfect strategy, but if you stick with it through difficulties, it works. Look at the historical odds of US market returns. 50 to 50 odds over 1 day, 68% odds over 1 year, 88% odds over 10 years, 100% odds over 20 years. Anything that keeps you in the game has a quantifiable advantage. Don't aim to be a perfectly rational investor. Aim to be a reasonably consistent one. Because the investor who sticks with a decent strategy for 30 years will crush the investor who perfectly times the market but bails out twice. Chapter 12. Surprise. This chapter is about why the future will likely differ from anything history teaches us. A political scientist once said, things that have never happened before happen all the time. Think about it. Most of the important 20th century events, World War II, the internet, antibiotics, the fall of the Soviet Union, were nearly impossible to predict in detail. First, you'll miss the outlier events that move the needle most. History shows the average, but wealth isn't built on average years, it's built on the rare, exceptional years. Second, history can mislead because the world has structural changes. The 401k didn't exist in 1950. The Roth IRA was created in 1998. Index funds were developed in the 1970s. Using pre-1970s financial advice today is obsolete. Consider 9/11. It directly led the Federal Reserve to cut interest rates. Those low rates helped drive the housing bubble. The bubble burst, leading to the financial crisis. The crisis led to a poor jobs market that led tens of millions to seek college education. That created $1.6 trillion in student loan debt. 19 hijackers created the student loan crisis. That's how unpredictable causality is. The majority of what's happening in the global economy right now can be traced back to a handful of past events that were nearly impossible to predict. Be skeptical of people claiming certainty about the future. The world is surprising. Chapter 13. Room for Error. This is about building resilience into your financial plan. Poker and blackjack players understand something most people don't. They're dealing with probabilities, not certainties. That's why they plan for things not going according to plan. That's why they have a bankroll that lets them survive losing streaks. Margin of safety, also called room for error or redundancy, is the only effective way to navigate a world governed by odds, not certainties. Consider, can you survive a 30% decline in your assets? On a spreadsheet, maybe yes, but emotionally, when your confidence gets shot exactly when opportunity is at its highest, can you handle it psychologically? Most people underestimate this gap. The biggest single point of failure with money? Relying solely on a paycheck for short-term expenses with zero savings. If that paycheck stops through job loss, illness, or crisis, you're in trouble immediately. But if you have 3 months of expenses in cash, suddenly, job loss isn't a catastrophe. It's an inconvenience. You have options. Morgan Housel thinks of his money as a barbell. He takes risks with one portion. He's terrified about the other portion. That's margin of safety. You can't prepare for what you can't envision. But you can prepare for uncertainty by building optionality, by having cash, by diversifying, by avoiding single points of failure. When the unthinkable happens, margin of safety is what saves you. Chapter 14. You'll change. This chapter challenges how most people approach long-term planning. Psychologists call it the end of history illusion. It's the tendency to recognize how much you've changed in the past while completely underestimating how much you'll change in the future. You've changed a lot since age 10, you'll change just as much by age 40. And again by age 70. But we don't believe this. Only 27% of college graduates work in jobs related to their major. 27%! That's shocking. Most people picked a career at age 18, then spent their lives locked into it, even though they changed dramatically. This is where sunk costs become dangerous. You make an investment, money, time, education, into a path. Then your preferences change, but you feel obligated to continue because of what you've already invested. It's like your past self is making decisions for your future self, and your future self resents it. Rather than viewing your life as one 80-year financial plan, think of it as 4 20-year blocks. Ages 25 to 45 might be about building. Ages 45 to 65 might be about consolidating. Ages 65 to 85 might be about freedom. Your priorities, income needs, and goals will be completely different in each block. Build flexibility into your plans. Accept that you'll change. The best strategy isn't one rigid 80-year plan. Chapter 15. Nothing's free. This chapter is about the hidden price of financial success. Everything has a price. The key with money is figuring out what that price is and being willing to pay it. The problem? The price of many things isn't obvious until you've experienced it firsthand. When the bill is due, most things are harder in practice than in theory. And most people can't identify what the price is until it's too late. The price of successful investing? It's volatility, fear, doubt, uncertainty, and regret. It's watching your portfolio drop 30% and wondering if you made a terrible mistake. Here's why so many people who willingly pay for houses, cars, and vacations refuse to pay the price of investment returns. The price isn't immediately obvious. When the bill comes due, it doesn't feel like a fee. It feels like a fine, like punishment for doing something wrong. Thinking of volatility as a fee, not a fine, changes everything. A fine feels like punishment. A fee feels like the cost of playing the game. If you view a 20% market drop as a fee for the privilege of earning 10% annual returns long-term, suddenly it's bearable. You're not being punished, you're paying the price. Here's the uncomfortable question from the book. Why do people willingly pay the price for cars, houses, food, and vacations, but try so hard to avoid paying the price of good investment returns? Because they don't understand that the price is non-negotiable. You either pay it or you don't get the returns. Chapter 16. You and Me. This chapter is about why financial advice can be so destructive. Here's the rule. Beware of taking financial cues from people playing a different game than you are. Short-term traders and long-term investors are playing completely different games with completely different rules. Bubbles form when long-term investors start taking cues from short-term traders. The short-term trader makes money on momentum, not value, so valuation doesn't matter to them. But when long-term investors start following their lead, suddenly valuation stops mattering to long-term investors too. That's when bubbles form. And when they burst, long-term investors get destroyed. Here's the key. Both can be rational. A short-term trader saying valuations don't matter because momentum will carry the stock higher is rational for the time frame. A long-term investor saying valuations matter because earnings will eventually drive price is also rational. But they're playing different games, and you can't mix the rules. The first step is defining your mission. Are you a passive, long-term investor optimistic about long-term economic growth? A short-term trader seeking momentum? Once you define your game, ignore advice from people playing another. Chapter 17. The Seduction of Pessimism. This chapter is about why bad news sounds smarter than good news. Pessimism isn't just more common than optimism. It sounds smarter. It's intellectually captivating. Tell someone everything will be great, and they shrug. Tell them we're in danger, and you have their undivided attention. This is evolutionary. Our ancestors who treated threats urgently survived better than those who noticed opportunities. That bias persists. Here's the asymmetry that distorts reality. Progress is slow. Setbacks are fast. Progress compounds slowly over years, barely noticeable quarter to quarter. Setbacks happen in an instant, impossible to ignore. Growth is driven by compounding, which takes time. Destruction is driven by single points of failure, which happen in seconds. Pessimists often extrapolate present trends as straight lines. Oil is running out and will run out by X date. What they miss? Human innovation and market adaptation. When oil becomes scarce, innovation in efficiency emerges. New extraction methods become economical. The straight line curves, threats incentivize solutions in equal magnitude. That's the common plot of economic history that pessimists forget. In the 1970s, oil crisis looked permanent, but efficiency and extraction innovation solved it. In the 2000s, oil prices soared. That made fracking economical. Another innovation emerged: be realistic about challenges, but don't extrapolate them forward as though they're permanent. They're not. Humans innovate, markets adapt. Optimism, belief that the odds of good outcomes are in your favor over time, is the realistic worldview. Chapter 18. When you'll believe anything. This chapter is about how stories matter more than facts in finance. Here's an uncomfortable truth. Stories are the most powerful force in the economy. More powerful than data, more powerful than facts. Consider this. 85% of active mutual funds underperform their benchmark over 10 years. That's a clear, verifiable fact. Yet trillions are invested in active mutual funds. Why? Because stories about stock pickers and market timers are more compelling than statistics. The more you want something to be true, the more likely you are to believe a story that overestimates the odds of it being true. You want to believe you can time the market, so you believe stories from people claiming they can. Data says otherwise, but stories win. Here's what happens psychologically. Everyone has an incomplete view of the world, but we form a complete narrative to fill in the gaps. We don't like saying, "I don't know." Instead, we construct stories that make sense to us. A psychologist noted, Hindsight gives us the illusion that the world is understandable. It makes us believe the world makes sense even when it doesn't. That's a big deal in producing mistakes. We look back at events and construct stories explaining why they happened. This creates the false impression that we could have predicted them. We couldn't have. When you believe appealing fictions more than uncomfortable facts, you make bad decisions. You believe a story about a hot stock instead of data showing diversification works better. You believe a narrative about market timing instead of facts showing time in market works better. Chapter 19. All Together Now. This is the synthesis chapter where Housel brings together the key lessons. Here's what all the lessons distill into. First, embrace humility. Control your ego. Less ego equals more wealth. Your possessions won't impress people the way you think they will. Second, use money to gain control over your time. This is the ultimate value of money. Not the car, not the house. Control over when and how you spend your days. Third, pursue wealth, not richness. Wealth is what you accumulate. Richness is what you display. The world confuses these. Successful people understand the difference. Fourth, accept that failure and risk are normal. Expect lots of things to go wrong. The winners are those who accept this and proceed anyway. Fifth, make saving a core habit. Not because of investment returns, but because flexibility and options are your real returns. Sixth, pursue financial peace of mind over maximum returns. A reasonable strategy you'll stick with beats a perfect strategy you'll abandon. Here's what ties it all together. Success with money is 90% behavior and 10% math. It's not about picking the best investments, it's about discipline, patience, humility, and thinking long term. A simple strategy, boring even, applied consistently beats a complex strategy applied inconsistently every single time. Chapter 20. Confessions. Morgan Housel reveals how he actually invests his own money. The opening disclaimer: what works for one person may not work for another. Find what works for you. But here's what guides all of Housel's decisions. Independence. Independence doesn't mean stopping work. It means only doing work you like, with people you like, at times you choose, for as long as you want. That's his North Star. Here's what Housel does. He paid off his house early. Mathematically suboptimal. He could have earned more by investing that money. But psychologically, owning his house free and clear provides peace of mind that beats higher returns. He keeps 20% of his assets in cash outside his house value for emergencies and opportunities. All stock investments, low-cost index funds. No individual stock picking despite having expertise and access. He maxes retirement accounts and contributes to his kids' 529 plans. His core philosophy: there is little correlation between investment effort and investment results. So why not keep it simple? Why not use a boring strategy you'll stick with? 3 key elements: high savings rate, patience, and long-term optimism. Sandy Gottesman, a billionaire investor, asks one question when interviewing: what do you own and why? That gap between what makes sense and what feels right is where most people struggle. Their head says one thing, their gut says another. Housel's insight: pick a strategy where both align, where what makes sense is also what feels right. Here's what Charlie Munger said: I did not intend to get rich, I just wanted to be independent. That might be the best financial advice in the entire book. Thanks for watching. If you enjoyed this chapter-wise breakdown of the psychology of money, make sure to like, subscribe, and comment below. Which money lesson hit you the hardest? See you in the next video.